It's not that the fundamentals don't matter, but let's just say a different set of fundamentals are in control. For years, we've talked about the news and trends that are driving the macro story of gold and silver. Silver especially. Silver has always straddled the fence, sitting between a valuation based on its properties as a monetary metal and its value as an industrial input. We've covered policy changes, supply and demand fundamentals, its role in the green energy revolution, de-dollarization, and more. But that's not what drove silver to $120 per troy ounce, and it's not what's creating volatility now. October 16th through November 21st. These are the days that defined one of the most reliable technical indicators known to investors, the cup and handle pattern. Immediately after its formation, silver began to rise without pause until it peaked on January 29th and dramatically fell the next day. Looking at the charts, it very closely resembles the infamous life cycle of a bubble chart that inevitably ends with a crash. That chart almost perfectly overlays silver's price action over the past few months. We're not the only ones who have noticed, and as others have pointed out, it's almost certainly the case that silver prices got ahead of themselves. But how? The how is important because how silver prices rose so quickly is also the reason they crashed so hard. None of this means that the underlying supply and demand fundamentals that we've been talking about have been invalidated. If anything, it provides additional support. Bubbles don't form out of thin air. There's always a reason why investors pile into a commodity or stock to send the prices soaring initially. But almost inevitably, margin and liquidity take over as the price drivers in this kind of rally. Think about it like this. Long-time investors in precious metals have watched for years as conditions tightened further and further. Silver stackers especially have been vocal that the commodity was well underpriced in real terms. These investors were buying silver at $20 an ounce and lower for years. Over the past several years, countries have poured billions into green energy projects that depleted above-ground stocks of silver. Mining investments to expand silver supplies have been limited at best. Silver is largely extracted as a secondary product from other mines, which makes it even more difficult to expand the supply. It adds up to one big deficit that's been going on for over half a decade in the silver supply chain. The macro stage is set. Long-time precious metal investors were ahead of the curve. The rest of the world got their wake-up call in 2025. Tariffs and trade wars changed the risk profile of materials across many sectors, but precious metals were especially concerning. Gold and silver may be coveted by kings, but in the modern world, it's still a commodity, and commodities trade on very thin margins. If precious metals were tariffed, it would immediately cause severe financial distress across the metals ecosystem. To reduce the risk, silver and gold were frozen in strategic stockpiles, essentially taking metal out of circulation. Some analysts suggest this was similar to experiencing a deficit of 500 to 600 million ounces of silver. In a normal year, mining supply is estimated to be between 800 and 900 million ounces. Instantly, lending prices increased for precious metals, and with it, gold and silver made headlines. Once again, new all-time highs and records were breached. The rest of the world noticed. As is so common, when investors want to capitalize on momentum in futures markets, and precious metals have a lot of momentum, they begin trading on margin. When a trader wants to invest, they put up a fraction of the capital needed to execute a contract, and the exchanges guarantee it. It's not exactly a loan, but it tends to work like one, and it makes the markets more accessible to a wider range of participants. All of this extra capital injected into the precious metals ecosystem causes prices to run away and for parabolic moves to take root. The irony here is not lost on us. The exchanges make it easier for investors to trade in the futures market, but that same accessibility leads to volatility. When the price runs away and volatility explodes, the exchanges begin raising margin requirements. Traders must post more capital per contract by the deadline set by the exchange. If they cannot, they are forced to sell, and forced selling leads to falling prices. The reason the exchanges alter margin requirements is to manage the risk they're bearing. The exchange sits in the middle of every futures trade, guaranteeing that both sides perform. When volatility surges, its risk increases. Raising margin requirements forces traders to put up more capital, which reduces leverage in the system. And when leverage is reduced quickly, parabolic moves often reverse just as violently as they began. If an exchange didn't raise margin requirements during a period of extreme volatility, leverage in the system would continue to build. Traders would control large positions with relatively little capital, and a sharp reversal could quickly wipe out their collateral. If enough traders failed to meet margin calls, losses would move up the chain to brokerage firms and potentially the clearinghouse itself. That kind of stress threatens confidence in the exchange, and confidence is its core asset. Exchanges make money from trading volume, but they survive on trust. Raising margin requirements reduces leverage before a break becomes a crisis, protecting the system and their own long-term business. Understanding this part of the silver ecosystem is vital for investors. Because parabolic moves always result in increased risk, it will always result in exchanges moving to protect their business. The faster and more violently prices move, the more margin requirements and liquidity will come to play a role in price setting. Over the past several weeks, we've had several days where silver has made some historic moves, in one case dropping over 30% in a day. This isn't because new mines came online, the refinery bottleneck cleared up, or de-dollarization slowed down. It's not because new revolutionary breakthroughs in science and technology reduced the need for silver. It's because the financial plumbing built to manage risk activated and did the job it was built to do. It's very easy to point our fingers at the exchanges and blame them for the end of a good rally when margin requirements activate and force selling among traders, but it's simply a risk management tool. And importantly, that system does not invalidate the very real concern that there's less silver to go around than there used to be. So keep your eyes on the fundamentals as we proceed through 2026. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.